Okay, let's proceed now. As I told you that there's a starting point and a stopping point. As for a particular site, you only start accumulating the cost when you already know your site, the site of use, right?
Okay.
Yes. So that's just a normal point. And lastly, they say that all this will be recognized. Obviously, any cost that did not form part of the cost of an asset, it will be expensed, right? Obviously, it will go to the income statement, obviously, right?
Okay.
Yes, so in the case of self-constructed assets, the asset maybe that which the company did not acquire, the same principles are applied if we acquire the asset. This is just normal. The other matters just normal, not a principle. If the
Yes.
entity makes similar assets during the normal course of the business, this was also put, to help some people. Let me tell you one thing, for some people, if you ask them, okay, is the vehicle a non-current asset or a current asset, they'll just tell you all of the non-current assets. But it depends. Let's say you're dealing with Ford. Ford is a car manufacturing company, right?
Yes.
It does the business of manufacturing vehicles. That is its business. So the vehicles manufactured for the purpose of sale, those ones are not non-current assets, right? The company does not treat them as non-current what? Assets. They treat them as current assets, and they can even call them inventory. Inventory, right? Or stock.
Yes.
Yes. So the company that does, it's like a bank. A bank has a lot of cash. Some cash in the bank may actually look like that, right?
Yes.
Okay, so that's why we say if the entity makes similar assets during the normal course of the business for the sale external, then the cost of the asset will also be, for this case now, the cost of the asset will be the cost of its what? We know its production. That is obvious, right? And so okay, this means that also the abnormal cost. Let's presume this now, right? This is what I wanted to speak of. This abnormal what?
Cost.
Abnormal cost. Let's presume this one, right? You need to make a certain product, right? And you need to make a
Yes.
certain asset. That asset, let's say, requires 200 kilograms maybe of a particular material, right? But
Yes.
maybe, unfortunately, let's say maybe due to inexperienced labor or maybe due to materials of lower quality, you find out that
Yes.
a lot of these 200 gets distorted, becomes losses, right? And so you find yourself that you have actually used the 300 kilograms to make an item that has only 200 kilograms. It means 100 kilograms have been lost, right? You
Yes.
cannot go on and say that, okay, the cost of the asset will be based on 300 because they are all incurred while making that. No, we say this is very wrong, right? We say that the cost
Yes.
of asset is only to what? Only 200. That
200.
100 cannot be taken to the cost of the asset. We'll take it as losses and they'll just be expense. That's what we're trying to speak of. Otherwise, it will be very difficult. You would have the same items, but some will cost more and some would cost less, just because of maybe some people lacking experience doing it. Right.
Yes.
That's what they're trying to speak of. The abnormal cost. So it won't
Cost.
matter whether it's on materials, you have used more materials, or maybe let's say it's labor. Maybe you use a certain labor and labor didn't work well, and then you had to hire another labor. So different types of labor worked on the same item, and so the cost was higher. And then you say, oh, I have to combine all these costs and put them to the cost of an asset. That also will be wrong. That's what we're trying to speak. I think we spoke of materials, we spoke of labor, right? And maybe they're
Yes.
seeing other resources here. So this one should be excluded from the cost of that of the asset. I'm happy actually. Until this point, you have raised your what? I'm happy. And I think I don't want to proceed with this subsequent. This is just a normal thing. We better go and look at an example, right? Because we have seen not initial recognition of an asset. I think we should go and look at what? An example. You have to see something.
Mm.
What we have remained with is just simple. When you reach at the measurement point, you can see. After here we have finished after page 6. But for this other, I think you should be going through them is fine because you know you may be doing some exercises and what. Okay, let's
Okay.
look at this question. What does it require? You know, it's better to know what the question requires. It says you are required to calculate the cost of what? Of the building
Mm.
that will initially be included in tangible non-current assets addition. So you need to know the initial cost of what? Of an asset, right? Okay, so if you look at this, we have been told an entity started construction of a building, right, for its own use on 1st April 2027 and incurred the following costs. So these are the costs incurred. Now be careful when you find a question like this because you have the table there, but you also have the following information down here, right? So
Okay.
for the question which the examiners actually do not want to cause problems to you, they would be marking this maybe Roman 1, Roman 2, and they would be marking the Romans here so that you know to get the actual picture maybe of this first line, I need to go to a certain one explanation. But for some, they will just be quiet like this, right?
Okay.
So if you find a question like this, you know you need to know how to match them. You may let's say you may choose maybe to start you start here, then you look up here for something that corresponds to it. Or you may take it up here and you go down here and you look for something that corresponds to it too, right? So it's just your
Okay.
choice. For example, let's say if you start from top here, we are told purchase price of what? Of land,
Nine.
240. I think purchase price of land, if nothing, there is no explanation. This is obviously part of an asset, right? As I told you, you need materials, labor, and what? On the overhead. So if actually you
Yeah.
purchase land, it should obviously form part of what? Of an asset. But maybe you don't know, maybe it is explained more here. But part one speaks of materials, part two speaks of what? Building ceasing its operations, part three speaks of you find out that there is nothing explaining that first part.
Mhm.
So you may say
Yeah.
obviously, okay, 240 included. Then you have the stamp what? Stamp duty. All right. All these duties are, if non-refundable, they should form part of the cost of what? Of an asset, just like we said. And so the stamp duties usually when you do pay, it won't be refunded. I don't know if you have the stamp duties there, right? But it really depends on what. But I think most countries would have these stamp duties, import duties, right? So the stamp duty
Yeah.
would also be there. Okay, we have the legal fees, right? Legal fees actually,
Yeah.
I, you know, like I told you that you have the purchase price, right? You have the input and duties and other non-refundable. You have the cost directly attributable to bringing the asset to working condition. Maybe you paid the lawyers, maybe they went on to check the land, right? They advised you, they
Yeah.
entered into the agreement. So it should obviously form part of the what? Of the asset.
Okay.
Yes. You would see it in that list. And it wasn't here when I did look here, right? But because the
Sorry,
first one speaks
sorry,
of
sir.
materials, yes.
Sorry, sir. These legal fees can research fall under these legal fees?
What?
The research.
Research?
Yes.
No, no. By legal fees, we speak of professional cost. Maybe you already
Okay.
have your place, right, of work, but maybe you need to secure it. Have said, okay, I'm going to use this place here, right, for work, for my work, but maybe I
Yeah.
need the lawyers to come and check. Sometimes you may go to land, you buy the land, and then someone tells you that, okay, no, this land is owned by someone else, right?
Yes.
Yes,
Yes.
that happens. So the lawyer maybe help you for that. But those costs of
Okay.
research, if you are still researching on whether to use a certain site or not, that one you will not have reached the point because you will not have made up your decision to use that site for construction, right?
Yeah.
So, like I told you, you only include the cost of site when you have decided that this is a site I'm going to do what? To use. It's like, let me give an example. It's like on financial management. In financial management, let's say you are trying to innovate it, to come up with a very innovative product, and so you need to do some market research. Let's say you have done the market research of 5 million, and you have discovered that the product will be a boom, right? It will give you a lot of profits. Now, when doing investment appraisal, investment appraisal is like you are trying to foresee the way of the cash flows you expect to earn and incur in the future, right? So whatever you incurred in the past, that research cost won't also form part of that. Because why? Let's say that you have already incurred $50 million on research, but if you look at your project, you are going to get 40 million. Then you say, okay, let me stop this project because here I'll get 40 million, but I already incurred 50, so I still have a loss of 10. How are you going to leave that? Remember that 50 was already incurred, it's already a loss. So whether you do that project or not, you have already lost that 50, right? Yes. So it's a sunk cost. So apply the same concept when we are here. Until you have made up your decision on a certain land, on a certain place to use, the cost incurred from then onwards will be actually capitalized to a particular asset, right?
Okay.
Yes. Okay. Now, here we're told site preparation and what? And the clearance.
Yeah.
Now, this site preparation is like you have already chosen your site. I'm going to use this site, right? Now, this is what people confuse. This will be included. If they said site selection
Okay.
and evaluation, you would have to ignore it, right? Because site selection and evaluation, you have not yet made up your decision on a particular site. So this can be confusing. You have to be careful here, right? Yes. And
Okay.
And then you have the materials. Now it's 100,000. We had information here on materials, right? We are told it was 100,000. We are told here material costs were greater than anticipated. Why? So this what is written here is greater than what anticipated. You have to know the reason now. We are told on investigation, it was found that materials costing $10 million had been spoiled and therefore wasted, and a further 15 was incurred on materials as a result of faulty design work. You see, this is what we call abnormal what? Abnormal cost. You incurred more, but actually what we did incur did not add anything, did not add value to that asset, right? I hope you get my point now, right? You take the cost which actually add value to that what? To that asset, right?
To that asset.
Yes. So here you have incurred 100,000, but actually not all of it. Some just came up because of issues. So those costs which resulted due to issues are abnormal costs, and you have to deduct them from there. We have to be careful. You see here, the figures were in thousand, right? You see here, but they're in millions, so you have to be careful. So here, I would deduct 10,000 because a million has 6 zeros. So if you deduct the 3 zeros, would remain with 10,000, right? 10,000, and here I'll deduct 15 what? Thousand from that 100. And let's look down here. See, yes, you can see here, right? 100 minus 10 minus 15, and we have how much?
75.
75, right? Okay. Now let's go back to so this two is done. Then we are here. Labor period from 1st April 2027 to 1st July 20 what? 8. So this is the labor cost. For how many months is? For 2027 it was 9 months, right? And then 2026 6 months, it's like 15 months. 15 months is you have to look at here we are told you are required to calculate the cost of the building. That will be okay. They just need the cost of the building. You have to be careful. Some questions like this, they could tell you that they need to know the cost to consider until the end of the year. Maybe the year ends December, right? So you can see maybe the year ends 31st December 2027 and they have provided you with the cost beyond 2027. So you need to know. But here they just need all the cost incurred, right? They do not care about maybe the cost which were incurred in this period or that period, right? Yes. So it's no big deal. So you just go down here. Initially it was 150, but we saw that we had some information here and we are told as a result of these problems, okay, these problems here, right, of spoilage and what? And faulty design, right? If there was faulty design, it means the design has to be redone, right? And redoing the design, it means it halted the job. So maybe labor stayed without what? Without working. That's why they say as a result of these problems, work on the building ceased for a fortnight during October 27, and it is estimated that approximately 9 million of the labor cost related to this period. You see this point now. So out of this 150, there is 9 million, there is 9,000, which was incurred, but the work was not taking place, right?
Okay.
You know, it could be that maybe the labor had the contract. So if someone has a contract, maybe you need to pay them maybe every month, let's say for the 15 months, you need to pay them regardless of whether they work or not. So we say that okay, we incur the cost, it's right we pay them, but it is not right to incorporate that cost into the cost of the what? Of the asset you are constructing because it was incurred while the work was not being done. It would kind of being overestimating the cost of that item, right? Yes. So that's why we would have to deduct it from what? This 150, right? So that's why you count down here, you find your labor, you deducted what? 9,000, right? And then you go back top and you are told architect fees, or these are just professional costs, right? Professional fees.
Yes.
So just like labor, just like legal fees, sorry. So it's just defined. You have the general overhead. I think this sounds obvious, right?
Yes,
It's
can
general overhead.
read it.
Yes, yes.
Yes.
So you have to ignore this, right?
Yes.
And lastly, you're told dismantling cost in 30 years, what? Time.
Fine.
I'm just trying to remind you, on those cost components, we had the first, it spoke of materials.
Yes.
Second, spoke of what?
Labor.
First of all, it spoke of cost. I mean, it was like the import duties and what? Those materials and labor, I try to speak to you so that you have that knowledge, right? Yes,
Okay.
yes. Although here they did not speak them specifically, but you have to, they just spoke them maybe they said for self-constructed assets. And then they started mentioning labor and what, but that labor should also be there. Then on number three, they spoke of cost directly attributable, and lastly they spoke of cost of dismantling. Okay, you have done your job, and then it's time maybe to break it down and they clear the land for other operations. Then that's what we call the dismantling what? Dismantling cost. Dismantling cost in 30 years time. This means that in 30 years you are going to pay how much? 20,000. But remember, we need the cost now, not in 30 years what? Time. So you cannot take this cost incurred now, right? And add them to the cost incurred to be incurred in 30 years time. No. We also have to bring this cost back in time from 30 years to now, right?
Yes.
So we need to discount it and get its present what? Value. That's why if you come down here, you see they are saying dismantling costs will be incurred in 30 years' time, and the cost of capital is 10 power percent. This is like the discount factor now, which I told you to get the present value. Let me show you here. I told that how do you get the present value? You take the future value, which is 30,000, 20,000, right? Here, you divide by 1 plus r power how much? Power n. 1 plus r. R of 10%, which is equivalent to 0.1?
0.1.
0.1. Then you raise the figure with the power of n, which is how much? 30. If you do that, you see the figure has been reduced from 20,000 to only 1,000. You see this? This is the present
This is
value.
per year?
Yes.
This is okay.
Yeah. Uh-huh. So you add them, right? You add them together and you arrive at what? At this figure here. So this should be,
Okay.
yes. Now, what about the cost? They tell that the ignored cost will be taken direct to the statement of profit or losses expenses, right? This
Yes.
cost here, this 10,000, 15,000, we have the 9,000 here, we have the general overheads which have not been capitalized, right? We'll take them to the what? The income statement. Don't worry about this. About this dismantling cost, you are going to meet this a lot, a lot. When you do study 37 provisions, contingent assets and liabilities, you would also encounter them. So no worries. There's a question specifically showing how to treat this. So far here you have not done the accounting, right? You have not done the double entries. We are just trying to know the cost of an item, right?
Okay.
So when it's time, you are going to see how double entries are made.
Okay.
We have said 1146. What is the entry on the other side? How do we, because look now, right now it's 1146, but in 30 years time it should be 20,000. So you have to know how this figure changes over time until it reaches 20 what? 20,000, right? So when doing I-16, you just need to go, actually just be careful, just do the revisions and what, because it carries a lot of weight when you do the other standards. I could tell you that what we're trying to do here is like we are creating a provision, right? Because I have an asset worth 1146, but I create a provision of 1146 and I keep increasing it until after 30 years then when it will be 20,000 and then I pay, right? So it's like we are already starting to explain about what? Provisions. So as of now, don't complicate matters. Just know that you discount this figure and you get your point here, right? I hope that was fine.
Yes, it was.
There is something which I didn't see for this case now. I didn't even want to speak of it because it was obvious. This point here. The building was completed on 1st July 28 and occupied on 1st September. Maybe I just need to ask you a question. Whenever you see something, you need to test, right? Look, this labor worked until 1st July 28, at which point the building was what? Was completed, right? But it was occupied on 1st September 28. My question now, we have not done depreciation already, but we spoke of it, right? When comparing it with impairment. At what point would you start to depreciate the building? From 1st July or when when you occupy it?
When you occupy it, which will be on 1st September
Yes, now look, it's not when you do what? Occupy it, right? Why?
Okay.
Remember, you constructed the asset for yourself. It's yours, right?
Yes.
It's what? This is the point you need to note. Let me put the star here, right?
Okay.
You start depreciation when an asset is ready for what? RFU, when an asset is ready for use. You see my point?
Yes.
If the asset is yours, whenever it is ready for use, you start what? Depreciation.
Okay.
With Now, this is different. This asset was constructed, right? But, some assets are bought. So if they are bought, you won't notice this discrepancy, right? That's what the first time I gave an example. You have bought two assets. One is in use and one is not. How about depreciation? We say that both are what? Are depreciated because both are ready for use. Both are ready for use, but you have just chosen not to start using one, right?
Okay.
If you're constructing the building, it's not.
You are right.
Yes, if you're constructing the building, it's not like you are going to buy it or what. It's already yours, right? So when it is ready
Yes.
for use, you don't need to ask anyone for permission or pay someone else. No, it's ready for use. I need to start depreciation, right?
Okay.
Yes. So for this case, in case they told you about depreciation should have started on the 1st July 21.
1st July.
Why? Because the asset was ready for what? For use. About the occupation, that would be none of our business, right?
Okay.
Yes.
Okay.
Now this, I think this is fine. Let's let's go back now. So at that point, we are just trying to get the picture. I'm just trying to get the picture of what to expect. If we are done with the 16, I will be very happy, and I will see that like everything is. There are standards. If you cover and you keep going, it becomes like you are revising this standard. This is the good thing about this
Okay.
financial what? Reporting. And so you won't even need
Okay.
to worry about, oh, I didn't touch this standard, I didn't touch that standard. No, you don't have to worry about that, right? You
Okay.
focus on what you are doing. That's how it's done. The other thing that we also need to go parallel here and there is consolidation of financial what? Statement.
Statement.
Yes, we won't have to wait for that. We'll reach a point where we'll have to go parallel. Standard consolidation. Standard consolidation that way. Okay. Now let's just finalize these little matters and then we would go to subsequent measurement. Initially now you have seen how to get the cost of an item, right?
Yes.
We are trying to explain how to get this cost of what? Of an item here. This one. All these explanations here. These ones I don't know. Purchase price, say import duties and what. That's what we're trying to get. And now we speak of subsequent. This too, you don't have to worry about this. This one is just an explanation, a normal explanation, so you don't even want to have to worry about this. They're just trying to say that, let's say maybe you have a building, you have created a building, right? A forum building, but let's say after 1 year you have said, oh, let me add another room, right? Yes. So it says that okay, you had your building, you were even depreciating it. You have decided to add an extension to the building. It's obviously it's a subsequent expenditure. It's an expenditure incurred after initially having completed your building and using it for some time, right? You get my point here?
Yes.
Yes. Are you tired? If you are
No,
tired,
no,
you
no,
have to
I'm not.
say.
No, 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 I'm not. Actually,
Eh,
we can still, we am learning, we have no power, but we can still continue. I'm using actually torch and then
oh no!
the
Listen, listen,
computer
listen,
itself.
listen, listen, listen. Don't. Okay, let's do this. Let's do this. I have to finalize some matters here. You shouldn't be in that situation. You can see,
Oh,
right?
but I want to find out if that,
Mm-hmm.
sorry if you can go back there.
Uh-huh.
The subsequent expenditure, can they be like capital expenditures since
Yes,
they're adding the value
yes,
to the
exactly,
asset?
exactly. So
Okay,
you see,
okay,
it's nothing much. That's what I'm telling you. I'm just trying to make you aware, but it's nothing much that is very relevant. No, it's just nothing, right?
okay, okay.
Let's do it by practical. Let's say initially you had an asset at 40, maybe you
Yes,
used it for 2 years, it depreciated by 10, right?
yes,
So the carrying amount was how much? Was 30, right?
great, yes,
Then maybe you added an extension of 5. It's just normal. You'd have to add this 5 to 30 that you have
okay,
by that time, right? It should be 35.
okay,
Then this will be your new, you can say this is your new cost, right? Then you look at the useful, you
yes,
just proceed. So it's nothing. There is nothing there actually, right?
okay,
Yeah, that's why I say parts of some items of property maybe may require replacement, for example, what, right? This
yes,
about this replacement we spoke of it about that aircraft issue, right? Maybe some use have a little useful life, shorter useful life. Others you have a longer
yes,
useful life, so you'll be replacing some while some are maintained. We spoke about that, right? So
okay,
it's
yes,
nothing much. Yes, it's nothing much. Yeah.
okay,
Okay, that's why I say expenditure
yes,
incurred in replacing or renewing a component of an item, plant, an item of property, plant, and equipment must be recognized in the carrying amount of an item. Right, you can see, recognize it there. That's why I showed you here. Right,
yes,
and the carrying
yes,
amount of the replaced, obviously, if you have an airplane or an aircraft, you are replacing this internal part with a new one. You'd obviously have to remove the carrying amount of what you replace and replace it with the new one with a new
Yeah.
cost. Yes. So it's just something. Or if you replace it, you remove what you just say we de-recognize. That's the proper accounting word, right? You de-recognize
Okay.
what you want to remove, and you recognize the new one, right? If maybe you are just adding an
Yeah.
extension, you are not removing anything, like I showed you. You have a building, you add an extension. It's like you're not removing anything, right? You are just adding on
Yeah.
an extension, something else.
Extension.
Yeah, so just add it, yeah, right.
Okay.
Mhm. All right, now exchange. Yeah, I think we can just go through, but my main point is that we are not going to start this subsequent what expenditure. You are going through that situation. It's not, I even don't feel fine if you are facing that.
No, it's fine. It's fine.
Fine.
My aim is it's fine. Yes.
Okay,
The
good.
torch actually it has even also light. It's those big ones they sell in shop, right? It's
Okay.
only that I think there's something they are working on. And
Mm,
so like today we don't have power, but then tomorrow,
to be
2 days we are
fine.
going to have power.
Okay,
Yes.
okay, yes, that happens. Okay, now let's do this.
Yes.
Since that is the situation, I'm going to change. I'm going to do this. Instead of explaining this way, the exchange of assets direct, I'm just going to mention these. I need to explain in a different perspective, right? In lieu of this
Okay.
situation. There are several ways of acquiring an asset, right? I would
Yeah.
write the way acquisition of what? Methods of acquiring an asset. Acquisition of assets. I'll just try to mention it so that maybe you may be asked someday. Ways of acquiring an what? An asset. This is what we do. There are several ways. The first obvious way is you need an asset, you go and what? And buy, right?
Yeah.
You go and buy.
And,
The obvious way. But also, instead of going and buy, you may exchange. You may do the what? The
the
exchange. Yes.
exchange.
So this is option number two. You may do the exchange. But number three, you may need an asset, but maybe you say, okay, I do not have money. Maybe let me go and lease. Right. You may
Okay.
lease an asset. They just say you may lease. But maybe you may also say, okay, I need an asset. I do not have a lot of money, but I have some, right? Have you ever heard of something called government grant? It is also part of non-current assets. You may use what? Grant.
Yes.
Yes,
Grant. Yes.
government grant. This is called IS 20. It is explained under IS 20, government grant. There are a lot of ways. Which other way could you say here? You may construct it by yourself, right? Self-constructed assets. You may say self-constructed. Instead of buying, you create it yourself, right?
Yes.
Self-constructed. So I wanted you to know that you may have different ways of acquiring what? Of having what?
Okay.
Assets. Buying assets is obvious. You initially recognize it at cost. Very obvious, right?
Yes.
Uh, Leasing assets will actually follow the terms of the lease. Lease is usually formed in a contract, right? So we have what? A
Yes.
contract, terms of the contract. Self-constructed is also obvious, like we have seen that asset of ours, right, in that question. You
Yes.
know that I purchased this one, I paid this price to transfer the items, I paid the lawyers this amount, I paid the architect this amount. Obvious. Grants too is obvious because for grants usually you pay a certain amount, like here, like buying, but some amount the government helps you to pay, right? Pays in your stead.
Okay.
So too is
Yes.
obvious. But now you have to understand why on exchange of assets I even prepared this session, right? Specifically
Okay.
for it. I did it because it has its complexities. It's actually not complexities, it's just normal, but it has some trickery on it. So you need it. That's why I did it. Yeah.
Okay.
On exchange of assets, you have two assets: the asset you are giving up and the asset you are acquiring, right?
Yes.
So the asset you are giving, each asset will have its carrying amount. Each of the two assets will have their carrying what? carrying amount, but also they could have the fair values. Of course, for fair values, it depends. Not all assets have fair values. Fair values are the values fetched in the market. So if it may be that an asset doesn't have a fair what? A fair value.
Fair
That's
value.
normal. Yes. Now, that's why I prepared this thing here. This order of what? Of preference. I mean it, right? What I mean is,
Okay.
first, there is a way of following this. First of all, we prefer the fair value, but under certain conditions. If not, it's when we follow the carrying what? Amount. That's why we say here, look, A16 specifies that exchange of items, regardless of whether the assets are similar, are measured at fair value. Usually, they are at fair what?
Fair value.
With no regard to whether the assets are similar. We don't regard that. Unless, so usually it's fair value. Unless we only not use fair value, the first point, if the fair value is not there, if it's not there, obviously, you cannot use something which is not available, right?
Yes.
That is obvious. That's what they're saying. I will start with this O here. I know I'm wrong. I should have started with the above one, but I'm starting with the obvious. Eh? Or the fair value of neither assets exchange can be measured what? Reliably. This is the obvious.
Right.
But the first one is unless the exchange transaction lacks commercial what? Substance.
Substance.
You have to get the point of commercial substance. We look at the risk, right? Risk, amount, and what? And the timing. You get my point here. Risk, amount, and what? And timing. I need you to get this point here. You will not explain this. I don't, sometimes they wonder. You may find even if you say they don't say this. But by saying it lacks commercial substance, it's like there is nothing actually to exchange. Let's say, presume that you're exchanging things which are exactly identical in risk, amount, and timing. It's like you're not exchanging anything. Okay, we,
Okay.
we have about a little time, but let me show you one thing. You do remember, I
Yes.
told you that present value equals to, this is what I do, right? Present value equals to
Yes.
future what? Value divided by
Value
what?
divided by
1
1 plus
R power n.
R
That's why I tell you, you need to know whatever you have, you need to
A.
manipulate it and understand it in full. By fair value, we speak of the amount. Fair value, that cash flow you expect in the future, right? If the cash
Yes.
flows, the amount here, cash what? Flows.
Amount.
Obviously. By timing, this n number of years, is the time, right? By
Yes.
risk is this cost of capital, this discount factor you use to discount. So whenever you need to know about commercial substance, you don't need to start memorizing, oh, I was told risk, amount, and timing. No. You just come to this formula. Okay, this is the cash flow, this is the discount factor, this is the time. You write the way you see is fine, right?
Okay.
Yes, this is the point. Okay, now my time is almost. Let me